to Sanjeev Prasad. All right, so Geoffrey Dennis is with us, independent emerging markets commentator. Geoffrey, good to have you with us here. Thank you very much for your time. Have you been watching the debate, the presidential debate, Geoffrey?
Yes, indeed, I have. I watched nearly all of it before I came upstairs to prep the call.
So who won?
I think probably Kamala Harris won at the margin. I don't think there was any knockout blows, frankly. There were no big mistakes, no big gaffes, as far as I could see. And I think, to be honest, it was the usual recipe of Donald Trump blustering his way through questions, changing the subject, rambling over all sorts of issues, coming up with facts that are clearly not correct at the time, but being very forceful with his arguments, some of which were false. Whereas Kamala Harris, I think, was calmer, wanted to talk about the future, not the past, and I think generally held up very well against ex-President Trump's, what should I say, heated rhetoric. Yeah, at the margin, I think Kamala Harris probably won it, but no knockout blows.
Geoffrey, got it. I don't know if there's any market implication. I guess not. Second, I want to just ask you about where yields across the US yield curve, the 2, 5, 10, everything was at at lows of the year, lows of the last 1 year. Oil prices are down $10 in the last $15 in the last 10 sessions. You've got base metal prices which are weakening. What does all of it indicate to you? And we heard that guidance from BMW. They've lowered their guidance out of Europe. Not a very pretty picture, right? Just going by some of these growth indicators.
I think that's right. And we've known for a long time, and you mentioned it a few moments ago in the program, that China is weakening and is going to continue to weaken, I think, for a while yet. I think the new part of the story, I think, is that the US economy is clearly at the margin weakening as well. I don't think it's recessionary remotely, but I think spending softening. And obviously, there's some weakness of the labor market coming in now. At least that's what the recent data would tell you. And I think that's going to translate into worries on behalf of investors. The global economy is slowing more significantly than expected. So all of that would be consistent with this steady move down in yields across the curve. The 2-year yield, of course, the 3-month Treasury yield Treasury bill yield by definition are going to reflect what the Fed is going to do in a few days' time. But I think the 10-year yield hitting 364 and a new low for the cycle, a new low for several months anyway, is reflecting on the weakness of the US economy and to a certain extent the global economy, but of course also the likelihood that inflation is going to fall sharply tomorrow, the headline number, and also the general move we're getting now towards the 2% Fed target.
So talking about this CPI inflation print that all investors are watching, it's important, no doubt, but is it going to be impactful enough to change the decision from a 25 basis points rate cut to 50 basis points rate cut? What is the market priced in? What can surprise?
I think it's possible it could change the cut from 25 to 50, although I think as most people understand now, the real economy data, especially the labor market data, is more important, I think, given how inflation is almost down to target. But the headline number tomorrow looks like it's going to be something like 2.5 or 2.6%, down from 2.9, because the comps with a year ago in August are fairly favorable. The core is going to remain about 3.2. The PCE price index is at 2.5 anyway for July. So I think if you were to get a real downside surprise here, it would really underpin the likelihood in that event that we would get a 50 basis point cut. But it's going to have to be a major surprise. My view is it's 60-40 in favor of a 25 basis point cut at this point in time. But I think people will take a look at the CPI number before they make their final decision on what the call should be.
All right. Hi, Jeff. Morning, and thanks a lot for joining in. Well, if going to be getting some rate cuts, then the dollar is going to weaken a little bit, which is in turn positive for emerging markets. That's normally how we look at it. But your preference from the emerging markets, you've had a view in the past on Mexico, on Korea, on India as well. So could you tell us, among the emerging market basket, what's your preference and where does India come in the, in the pecking list?
I posted on LinkedIn today arguing that there've been two drags on the emerging market index this year, and they've both been quite strong drags. One has been the terrible performance of China once again after 3 prior years of weakness. And the other issue has been the dollar. The dollar is actually relatively flat, up slightly, I think, on the year now. But it's been all over the place, and there's been no reliable dollar trend, certainly in a downwards direction, which has given EM sustained momentum. And since late August, when you've seen people focusing more on 25 rather than 50 basis points from the Fed, the dollar's actually appreciated a little bit by about 3%, and that's pulled the emerging markets back once again. You're right. If the Fed is going to cut and cut more, of course, over the next several meetings, the dollar logically will fall. I don't think it'll collapse. I've got it posted around 112, 113 against the euro in early 2025. That will, at the margin, help emerging markets. I like here India still over China for sure. I like Taiwan to rebound a little bit after some difficult times recently in August. I do like Korea as a bounce back story. I like Brazil over Mexico and Latin America. I called the ASEAN market upside recently, excuse me, and that's been doing well, the ASEAN region, Southeast Asia. And I also like Central Europe. So there's a few things to go on there. But in terms of big markets, India, Taiwan, and to a certain extent, Korea.
All right. We leave it there, Geoffrey. Good to speak with you, as always, and good to get that view across. Appreciate it. Well, that's